Hi everyone, it's Jack about another video, and today we talk about Citigroup. Released its earnings last week. I want to talk about this business. It's really interesting as far as I'm concerned. It's the smallest of the big four banks by quite a margin. $80 billion market cap, so the next closest is Wells Fargo, $140 billion. It's down 9% year to date, down 40% in the last 5 years. Revenue is stagnating, it's not far off its 52-week lows at all, and currently it's trading at less than 0.5 times book value, so a 50% discount to book value, absolutely staggering. And not to mention a PE ratio around 6.5, by far the cheapest of all its peers on a like-for-like basis. So I'm going to discuss its most recent results, to discuss its wider stagnation, what it needs to do to get back on track, talk about its dividend, which is currently over 5% right now, how much it buys back shares, general returns to shareholders, and then in prospects going forward. So here are Citi's most recent financial results, and it does not paint a pretty picture for this business's recent history. Total revenues of $19.4 billion, that was down 9% quarter over quarter and 1% year over year, for a total year-to-date revenues of just shy of $41 billion, which is still up 5% year over year, but the most recent numbers are not very impressive. Decrease of 1% year over year. They saw growth in services, USPB and revenue from the investment portfolio, but this was offset by markets, investment banking and wealth. This is a general theme across this business, is that there is not really that much of a market for investment banking right now. The IPO market is severely down. Mergers and acquisitions are not happening anywhere near as much. That's partly because the cost of capital has gone up so much with higher interest rates. It's also just because it's a tougher market for IPOs. Investment banking businesses are suffering, and Citigroup's investment banking arm is definitely suffering. Net income was down 37% quarter over quarter, which is absolutely stinks. 36% year over year, and in total it's down 15% year to date. They still recorded $3 billion of net income for a diluted earnings per share of $1.33, but that was down 39%. And the year-to-date number is down 16% year over year. Just not good enough. They blamed expenses, which have gone up 9% year over year, and increased interest rates, which means they're not being able to generate as much net interest income, or enough margin on that net interest income. Cost from credit cards of $1.8 billion. This should around continued normalisation, so that's not as bad. Effective tax rate of 27%. But that net income number, combined with effectively flat or just below flat revenues, net income number absolutely stinks. This is not a strong quarter in my opinion. That increase in expenses is really interesting, and what they want to do is simplify the platform and processes, reducing complexity and risk, improve their infrastructure basically, modernise the security, increasing security efficiency and scalability, which is just something they absolutely have to do. Any modern bank is having to do this. They want to improve client experience, so drove particularly across the wealth section, and data improvements, making better decision making and risk management, which most banks are going to be doing. They added 7,000 people in technology across the year, so that's a total technology related spend up 13%. But this is still not what we want to see. What we really want to see Citi doing is returning capital to shareholders, running a lean business, and investing in crucial elements of this business, and particularly investing in that client experience. I think some of this is a bit of fluff and not necessarily what these need to be invested in. In terms of the balance sheet and capital management, their end of period assets looked a little bit better compared to what it was last year. That was primarily driven by an increase in cash of 5% and an increase in trade and related assets of 5%, with a slight decrease in the other asset category, loans being basically flat and investments being down 1%. So that gave for a total 2% increase. Most of that was due to cash and trade and related assets. What is interesting here is looking at the tangible book value of this business. Year over year has increased from $80 to $85. As I mentioned, this stock is currently trading for around $41. It's trading at a well above 50% discount to its tangible book value. And while this is a relatively stagnant business in terms of revenue, and net income has decreased recently, this is still a very, very cheap business with, aside from its net income problems and stagnant revenue, it's actually running a relatively tight ship. It's not growing how you would like it to, but other metrics here are relatively impressive in my opinion. It came out in the news a couple of days ago that Citi is continuing its strategy that was announced in 2021 of trying to simplify the business, move it to not necessarily entirely US focused, but simplify its geographical spread basically, which is absolutely what a business that is struggling to grow revenue and struggling to find any growth really should be doing, is trying to simplify. And that is that they're selling the $3.6 billion China retail assets business to HSBC. Absolutely want to see, and I'm happy management are executing on this strategy to try and simplify what is definitely an overly complicated business. Now it's time to decide what is a reasonable valuation to pay for this business. It's clearly not a growth business. The revenue is basically stagnant, if not down a little bit in the last few years. The stock has absolutely plummeted and net income is not where it needs to be. However, there's definitely a viable stock here, in my opinion. First of all, the amount of margin of safety is absolutely massive. For me, currently it trades a price of book value of 0.42 times. That is absolutely ridiculous. One of the lowest you'll see, far lower than its peers. Price to earnings on a trailing basis around 6.5, and even on a forward basis around 7.4. These are low. Of course, Citigroup generally trades at a discount to book value and a discount to its other banking peers, but not this much. A 5-year average price to book value of 0.67 compared to 0.42. 5-year price to earnings on a trailing basis around 8 compared to 6.5. This is, by basically any metric you look at it, a very cheap business, particularly when compared to its peers. Now, one can argue that is because of its recent performance, and I wouldn't argue against that. It has performed poorly recently, but I do think there's definitely a story here, and I think there's a significant margin of safety. I mean, just look at that earnings yield, which is the reciprocal of the price to earnings, around 15. That is absolutely staggering for a business that, make no mistake, I don't think this is going anywhere. It's just in a rut, certainly, but it's not going to go bankrupt anytime soon. So there's definitely a price that I would be willing to pay for this business. When you look at it compared to its peers, that being the other three of the big four banks, it is by far the cheapest. Wells Fargo being the most expensive, around 10 times earnings. Bank of America 7.8 times earnings, and JP Morgan at 9.4 times earnings. Citi at 6.5. All of these being trailing earnings. Looks way the cheapest here, and on a price to book value basis, JP Morgan trading at almost 4 times the value of Citigroup on a price to book value basis, and Bank of America and Wells Fargo double and just slightly more than double. So Citigroup clearly is trading at by far the biggest discount to book value and a significant discount to its peers. So we definitely have a relatively cheap but stagnant revenue-wise business. Looking at the dividend is anything but stagnant. You can see how the yield has just exploded since 2014. Part of this is from the stock price dropping, but the dividend payout has doubled since 2018. It's generally gone in one direction with a slight dip in 2019, but this is up and to the right. The dividend growth has slowed down in recent years as the net income growth just hasn't been there, but it's at a decent payout ratio, and right now it's an above 5% yield, so I'd be very happy with that. This business not only returns capital to shareholders in the form of dividends, but also share buybacks. They have slowed a bit in recent years, so in the most recent quarter, around $2 billion of share buybacks, which is not outstanding by any means on an $80 billion market cap company. But you can see quarterly shares outstanding has increased at a rapid rate over the last couple of years. So in 2013, they had around 3 billion shares outstanding. Now they have less than 2 billion shares outstanding. And most of the time they're repurchasing a significant amount of shares. You can see in 2019 and 2020, some quarters they reduced the quarterly share count by around 10%, absolutely staggering. So overall for me, this is definitely a value play rather than a growth play. Don't think the revenue is going anywhere quick, and I'll be happy to see some simplification from this business, continuing the simplification strategy, sorting out the cost structure, just getting net income to go in the right direction. But I think there's significant margin of safety compared to price, particularly in that price and book value when we look at it versus other banks. Some of those banks, the higher quality ones, I would say Bank of America being the higher quality, and JP Morgan, you expect them to be, price book value of 1 and above. Citi, I would probably say I'd be happy to pay 0.7, 0.8. We're looking at 0.42 now, far below its 5-year averages, far below even where it was in 2013, 14, 15, where it's more like 0.8 times book value, which I would say is a normal figure. It's currently trading with a 5% dividend yield that looks relatively safe going forward. It's at 52-week lows, and it buys back shares on a regular basis. Don't think it's going bankrupt anytime soon. There's a nice margin of safety here, and I might just be picking up a few shares soon. Of course, all this is just my opinion. You should let me know what you think in the comments down below. I'm not a financial advisor, so none of this should be taken as personalised financial advice. You should do your own research and due diligence, come to your own opinions, and remember your capital is always at risk when investing in stocks. So let me know what you think in the comments down below. Like and subscribe and enjoy the video. I'll see you again next time.